Welcome to the Moon Mark. Today, we're taking a deep dive into Tether, the most widely used stablecoin in the world. What exactly is it, how does it work, and why does it sometimes lose its peg to the US dollar? And most importantly, should you trust it? Stick around because we're covering everything: its mechanics, the benefits, the risks, and the controversies. Tether, or USDT, is a stablecoin. In simple terms, that means it's designed to always be worth $1. It's pegged to the dollar to give traders and investors a stable asset in the volatile world of cryptocurrencies. But achieving this stability in a decentralized and ever-changing environment isn't as simple as it seems. Let's break it down. First, let's talk about how Tether works. The cornerstone of USDT is its claim that every token is backed by real-world reserves. According to Tether Limited, these reserves include cash equivalents like short-term US Treasury bills, and other assets like secured loans or corporate bonds. This reserve system is what's supposed to ensure that one USDT can always be redeemed for one actual dollar. Here's how the system operates. When someone deposits fiat currency, like US dollars, with Tether Limited, they mint an equivalent amount of USDT tokens. For example, if you deposit $10,000, Tether mints 10,000 USDT. That USDT can then be used for trading, payments, or even transferring value across borders. On the flip side, when you redeem USDT for fiat, Tether burns those tokens, taking them out of circulation. This minting and burning process is at the heart of how Tether manages its supply to maintain its dollar peg. But maintaining that one-to-one peg also involves market mechanisms. This is where arbitrage comes into play. Let's say the value of USDT drops below $1, for example, to 98 cents. Traders step in to buy cheap USDT, redeem it for actual dollars from Tether, and pocket the difference. This increased demand for USDT pushes its price back up to the $1 mark. Conversely, if USDT rises above $1, let's say to $1.02, traders sell their USDT for more than $1, increasing supply and bringing the price back down. So far, this system sounds pretty robust, but Tether is far from controversy-free. In fact, it's faced significant criticism and skepticism over the years. Let's explore the risks and uncertainties that surround Tether and why its dollar peg occasionally falters. The first major issue is reserve transparency. Tether has been criticized for not providing clear, third-party audits of its reserves. While the company does release periodic attestations, these are snapshots, not comprehensive audits. The big question here is, are all USDT tokens truly backed by real assets, or is Tether operating on fractional reserves? This lack of clarity has been a key factor in eroding confidence among some traders and investors. The second issue is regulatory scrutiny. Tether has been under investigation by regulators in multiple jurisdictions. For example, in 2021, Tether settled with the New York Attorney General's office over claims that it misrepresented the nature of its reserves. Although Tether paid a fine, the case raised concerns about its operational practices and transparency. Continued regulatory pressure remains a risk that could destabilize its peg or its dominance in the market. Another challenge is redemption limitations. Tether imposes fees and minimum thresholds for redeeming USDT for fiat currency, making it difficult for smaller investors to cash out directly. Instead, many rely on secondary markets or exchanges, which can create inefficiencies during times of market stress. For example, during crypto market crashes, when everyone wants to sell USDT, it can temporarily lose its peg due to liquidity constraints. Finally, market confidence plays a huge role. Tether's value is ultimately tied to trust that it's fully backed, that it can meet redemption demands, and that it can withstand regulatory scrutiny. If that trust erodes, traders may rush to dump USDT, triggering sell-offs that could destabilize its peg even further. Despite these challenges, Tether has undeniable benefits, which have cemented its role in the crypto ecosystem. Let's shift gears and talk about the good things Tether brings to the table. First, Tether provides massive liquidity. It's the most traded stablecoin in the world, with billions of dollars in daily trading volume. This liquidity is crucial for crypto traders and exchanges, as it allows them to move in and out of cryptocurrencies quickly without being exposed to volatility. Second, Tether is a valuable tool for hedging against market volatility. When crypto prices crash, traders often flock to stablecoins like USDT to preserve their capital. It acts as a safe haven in the highly volatile crypto market. Third, Tether enables fast and global transactions. Because USDT is blockchain-based, it can be sent anywhere in the world within minutes, bypassing traditional banking systems and their associated fees and delays. This makes it an attractive option for cross-border payments. Lastly, Tether plays a key role in decentralized finance, or DeFi. It's widely used in lending, borrowing, and yield farming, powering many of the protocols that are reshaping the financial landscape. So, where does this leave us? Is Tether perfect? Absolutely not. Its centralized control, lack of full transparency, and regulatory pressures are legitimate concerns. But it's also a critical piece of the crypto ecosystem, providing stability, liquidity, and utility in ways that few other assets can. In the end, whether or not you trust Tether comes down to your risk tolerance and how much faith you have in its reserves and operational practices. But one thing is clear, Tether has become an integral part of the crypto world, and its influence isn't fading anytime soon. Thanks for sticking around to the end of this video. What do you think about Tether? Do you trust it, or do the risks outweigh the benefits? Let me know in the comments, and don't forget to like, share, and subscribe for more deep dives into the crypto universe. See you next time.